I believe Zillow.
What?
Believe it or not.
Are you, serious?
I think that you only see a decrease of another 1%. June 1st is looming right now. And if you don't understand the meaning behind the deadline of June 1st, you need to get on the news and get online and look at what's going on in our country right now. June 1st is a deadline when the government needs to start paying off its debt. And that is a big problem right now. And it's a big discussion in Washington between Congress and the Senate. And things are getting really heated. And they've been going back and forth about, raising the debt ceiling. But then they want the other side to control the spending. And there's all this back and forth. And us Americans are sitting here saying, what in the heck are you guys doing?
What in the world is going on?
Is it going to default? Will the government default? Probably not. A lot of analysts are saying that the likelihood of that happening, it's very slim. But I would not put anything past our government right now. So there are some analysts out there that are predicting what could happen if the government defaults on its debt. It's not pretty, folks. It's not. But let's talk about that today. I'm going to share you Fortune.com's latest article that talks about this very thing. And they quote Mark Zandi from Moody's Analytics. He's the chief economist for Moody's. He breaks down what could happen to the housing market if the U.S. does default on its debt. So sit down and watch and just get ready. Let's get started. The spring housing market, you've heard me talk about it. It's been a dud, a complete dud, just totally stagnant. The sales have declined. Listings were down. Prices did go up in some markets because there's no inventory. But overall, the market's just been stagnant. I know for me as a real estate agent, it hasn't been one of my better years. I'm not going to lie. So it's actually given me a lot of time to sit back and do all this research for you guys to explain what is going on. And I got to tell you, between the rising mortgage rates, the Fed's raising interest rates, banks collapsing, and now we have this threat of the government defaulting on its debt. Oh my God, can there be anything else that we can throw into this mix to make things more stressful for the American people when it comes to buying a house?
Hit me, baby, one more time.
You got anything else you want to throw at us? I mean, what else? What else you got? Because I don't think we can take too much more of this. All right, I digress. Let's get into this article. This is from Fortune.com. The headline of this one, it reads, "The housing market correction would regain new life if the U.S. defaults," says Moody's chief economist. Now, before I proceed, this headline is a little deceiving. Are they trying to maybe give hope to people that this default would be a good thing and it's going to boost the housing market? It's going to help the housing market? I'll explain to you in the article exactly what they're referring to, why they're saying it's regaining new life. So the article goes on saying, speaking in front of Congress earlier this month, Moody's Analytics chief economist Mark Zandi told senators that by his calculation, the U.S. Treasury could run out of cash as soon as early June. If Congress doesn't act and the U.S. were to default, it would have broad economic consequences. You think, Mark Zandi, really? You had to tell them that? That's pretty pathetic if you're the one that has to tell our government that. One of the most vulnerable areas of the economy being the U.S. housing market. In the unlikely scenario that the U.S. Treasury were to default or even appear like it might default, financial markets would put upward pressure on long-term rates like mortgage rates. The average 30-year fixed mortgage rate, which sits at 6.55% as of Friday, he says could go back above 7% if a default looked likely. Another big jump in mortgage rates would be a gut punch for many home buyers and sellers who were at the brunt of last year's mortgage rate shock. Already, national housing affordability, or better put, the lack of affordability, has reached levels not seen since the housing bubble era. If mortgage rates were to spike again, housing affordability could deteriorate to a level that exceeds the bubble. This is where this headline is bringing new life to the housing correction. This is what they're referring to, this section right here. If mortgage rates were to go higher, Zandi says, it would accelerate the ongoing housing market correction, which lost some momentum this spring. The latest forecast produced by Moody's Analytics, which doesn't factor in a default, expects U.S. home prices, which are already down 3% from 2022 peak, to fall 8.6% peak to trough this cycle. So this is what Mark Zandi is actually saying. He's saying that if the default happens, mortgage rates are going to soar He's saying that's going to really accelerate the housing correction. That's going to bring prices back down. Okay, I see where he's going with this one. But does this solve the inventory issue? We still have 85% of people in this country that have mortgage rates below 4%. Going up to 8% or higher, yeah, it's going to pull people out and it's going to force sellers who are currently on the market to drastically reduce their prices. I get that. But for this correction to really move forward, we need more inventory, right? It's not going to happen. It's not going to happen. People are not going to put their home on the market now that the rates are even higher. Those golden handcuffs of interest rates below 4% are the culprit here. This is the problem why we can't get ahead. We can't get these prices down and houses can become affordable. This is the big problem. Hey, you got to do me a big favor before we move on. I know this is important. You got to hit the like and then also subscribe while you're at it too. Thanks. Now, the article goes on to say that on Thursday, Zillow published an article with the headline, "A debt ceiling default would send a U.S. housing market back into a deep freeze." While Zillow economist Jeff Tucker acknowledges that a U.S. default would be unlikely, he agrees that it'd see mortgage rates go higher and put the housing market back into a sharp slowdown. If the U.S. were to default, Zillow predicts the average 30-year fixed mortgage rate would spike to a peak of 8.4% by September, while home sales volumes would fall 23%. When it comes to home prices, Zillow thinks a default would see national home values go down another 1%. Any major disruption to the economy and debt markets will have major repercussions for the housing market, chilling sales and raising borrowing costs, just when the market was beginning to stabilize and recover from the major cool down of late 2022. So here's the deal. Overall, Zillow is saying that the housing market will go into like a deep freeze. It's going to be stagnant because they're predicting prices are only going to come down another 1%. If these mortgage rates go up to 8.4% in September, overall prices are going to come down 1%. 1%. Because again, there's nothing for sale and no one in their right mind is going to want to put their house on the market and trade up for a mortgage rate of over 8%. Not happening right now. It's not. So be careful what we read, folks. That's the lesson of the day. As I say this all the time, be careful what you see on the internet. Even though this guy from Mark Zandi from Moody's is saying, yeah, it could accelerate the correction. Not really. That's not much of a correction. We're going to be in this seller's market for quite a bit longer, guys. I hate to say it. Until the inventory issue gets better, this is it. This is what we're dealing with. Again, be careful what you're reading out there online. You just have to. Now, again, getting back to what's the reality? Are they really going to default on the debt? Everyone is saying no. As a matter of fact, one analyst said it's like a less than 10% chance that it's going to default. But it's always good to be prepared. We don't want to sit back and trust what everyone is saying because you never know. I'm the type of person, I always proceed with caution and I be careful with what I read online and I really dig deep into this and try to figure out what in the heck is going on. But as a real estate agent in this market right now, and from what I'm seeing and reading this stuff every single day and looking at what the markets are doing across the country, you're not going to see a major price decline. You're not. Sales, they said, sales will go down. Prices are not, regardless, even if this default happens. Like I said, I believe it or not, I believe Zillow.
What did you say?
Believe it or not.
Are you actually saying that?
I think that you only see a decrease of another 1%. That's it. That's it. And I hate to say that, but I think this is where we are at, guys. So let's hope that this does not happen, that the government doesn't fail us and default on this debt, because not only it will send the housing market into a tailspin, but the entire economy altogether. So let's all pray that they all do the right thing. They'll get out of this mess and please stop throwing all of this extra stuff for us to stress about. I mean, it's bad enough. We're dealing with so much with this housing market. Just, God, can it just stop? Please just end. If you haven't watched my live streams lately, I highly recommend you check out the live stream I did last week because we did talk about this very topic as well. I had a mortgage lender on to explain exactly what would happen with the mortgage rates. I think you might find that interesting as well. If you also need a real estate agent in your area, there's a link down below. You can click on my website. There's a form there you can fill out. It'll come on over to me and we can have a conversation and I can get you connected with a real estate agent in your area to help you make your next move. Thank you so much for watching me today. My name is Jackie Baker, and I will see you next time.